But today, I'm really excited to present to you some of our data and findings from the State of Warehouse Labor 2023 report. It's a report that we did last year as well, so we have some interesting comparisons to make. We're looking at the overall situation in the light industrial, logistics, distribution, fulfillment area, and also some of the things that are the most pertinent for people who are dealing with staffing challenges going into this year. And we'll talk a little bit about what the economic situation might look like as well. So just a quick agenda for you all. We're going to talk about the economic situation, as I said. I'll introduce the State of Warehouse Labor report, role of flexible work, and we'll have a Q&A. And before I jump in, I just want to give a quick introduction to Instawork. I appreciate the introduction we already had. We are an online marketplace for flexible work. We connect our network of more than 4 million pros from around the US and Canada with thousands of businesses in dozens of metro areas. We do a lot of work in the light industrial area, a lot of warehouse shifts transact on our platform. We also do hospitality, commercial cleaning, housekeeping, a whole bunch of different kinds of in-person hourly work that can be done on a flexible basis. We are really pleased to be able to present to this group. We have plenty of partners within this group, and we hope that we'll be able to make some more, of course, as well. So let's just take a look at the economic situation right off the bat. If you look at some of the gauges of pressure on supply chains, and this is a picture of the Federal Reserve Bank of New York's Global Supply Chain Pressure Index, it seems to have gone down quite a lot in the last year or so. We hit a peak earlier on in the pandemic when supply chains were really clogged. We had problems with all sorts of things, whether it was energy prices or staffing or insurance or just transport. And those seem to have disappeared at a global level quite a bit. Now, if you look at what happens that caused this change, we had kind of stalled demand for goods in 2022 last year, as a lot of consumer spending, especially in this country, shifted to services. That really started to happen in the spring last year. And as a result of that, a lot of inventories built up on shelves. There just wasn't as much spending on goods as anticipated. And so there were a lot of inventories on shelves at all parts of the supply chain, all the way down to the retailer. And some businesses were able to reduce that somewhat with discounts during the holiday period, and others still are dealing with inventories today. We also had a big drop down in energy prices, and that was something that really helped to mitigate some of the factors that caused these pressures. So there were a bunch of different reasons why this supply chain pressure dropped off, though you may not feel like this steep decline on the graph represents your own experience perfectly, but that's what it looks like at the global level, according to the Fed. But when we look at data from manufacturers, we still find that there are issues, especially with getting inputs that they need and logistics. The data that you see in this chart are from the Census Bureau. They do a quarterly survey of manufacturers. They ask about why they might be producing under capacity. And I've done a comparison here of the fourth quarter of 2022, that's in blue, with the fourth quarter of 2019, right before the pandemic really began, in gray. And you can see some differences. Almost 40% of manufacturers cited labor supply as a drag on production, which is much higher than it was before the pandemic. And roughly 3 in 10 cited difficulties getting their raw materials. That's also much higher than it was before the pandemic. And so are the problems with logistics. They're not terribly prevalent. Maybe only about 10% of manufacturers said they were producing under capacity because of logistics problems, but that's still 4 times higher than it was at the end of 2019. So we're still dealing with some of these problems. We're not quite back to normal yet when it comes to production. Now, as we look forward, some of those inventories, as I said, are starting to draw down. You can see just how steeply they increased, and they're just starting to level off at the end of last year into the beginning of this year. That's a chart on the right from the Bureau of Economic Analysis. We'd never seen such a steep increase in inventories before, ever. And so it's going to take some doing to get rid of that overhang. Now, once we draw down those inventories, then goods might start moving a bit more again through the supply chain, and that could restore some of the supply chain pressures that we saw, as it just gets a little more congested. But at the same time, the economic headwinds that we're facing, with more predictions of recession perhaps for later this year, the GDP numbers out today showing a pretty market slowdown already, could reduce demand. And actually, if you look a little deeper into what manufacturers are saying, Orders are down. We see numbers that we haven't really seen since 2020 in terms of those declines, some numbers that we haven't seen since 2009 in terms of drops in orders and manufacturing volumes. So there are definitely some signs of a downturn out there, and that could actually help to keep pressure off supply chains, but it just means that fewer goods are moving around. And the other thing that we need to watch out for is volatility in labor, because even though we may be sorting out some of these other supply chain issues, the labor issues haven't gone away completely, and they're actually a growing issue. If you look at this chart on the right here from the Bureau of Labor Statistics, it's a chart of the count of all employees in transportation and warehousing across the US. That's how they classify it. And you can see it's very seasonal, right? It peaks at one time in the year, then it goes back down, then next year it peaks again. But the amplitude, right, the overall volatility in this chart has been going up very strongly and in excess of the proportion that the overall employment has actually grown. In fact, the seasonal swings that we see here used to be about 2% plus or minus over the course of the year 2 decades ago. Now they're about 5%. Even before the pandemic, they were much higher. And that just means there's a lot more volatility. It's a lot more challenging to figure out staffing in this sector right now. And of course, the economic trend that we have now with all the uncertainty in the economy and the pandemic are just adding to that volatility. You can see some of these sharp ups and downs in the past few years. Another thing that's worth noting is when you're facing a lot of volatility, the traditional type of employment, full-time employees who are on a permanent basis, and also automation are less cost effective, right? Because if you're basically sticking with the same number of employees, or if you have fixed machines that are in place, equipment that's in place that you're always paying for month after month, it may not correspond to demand, right? You can see employment is actually moving up and down more and more as you go further in time across this graph. And that's just reflecting underlying demand, right? The seasonality of demand is really what's driving this. And if you stick with the same mix of employment, you have the same amount of automation set up all year, then sometimes you might be straining capacity, and other times you're just going to have idle resources. So there has to be a way to become more flexible. So now I want to shift to some of the findings from our State of Warehouse Labor Report. We surveyed more than 400 businesses in the sector. We got great responses from executives and managers across the sector for a variety of questions to do with the economic situation in the labor market. Overall, businesses saw fewer problems with staffing in 2023 than they experienced in 2022. So they're expecting things to get a bit better. And that goes across a couple of different axes. First of all, they're more confident about attracting workers than they were in 2022. So in terms of recruitment, 85% of them said they were they expected to be effective this year versus 76% going into 2022. So there's more confidence for recruitment. And they're also more confident about retaining workers, 76% for this year versus 59% last year. I mean, imagine that last year, just over 40% of businesses were not confident about their ability to be effective retaining workers. That's a pretty striking number. And that has come down. So that's good news. And it'll be especially good news if it means less revenue left on the table. Last year, our survey respondents reported that about a third of them had to forego revenue because they didn't have sufficient staff. And that was actually slightly up versus the previous year. So we're hoping that in this year, 2023, with staffing a little bit more under control, there won't be quite so many businesses that have to leave revenue on the table just because they can't flex to that capacity. Now, businesses are using quite a wide variety of tactics when it comes to retaining staff. We have a chart here that gives you half a dozen of them and shows you which ones are being used in 2020 or are planned to be used in 2023 versus 2022. You can see that increasing pay comes out on top, but in 2023, which is the dark blue bars, it's only about half of the respondents who said that they were going to lean on that, whereas it was 60% for last year. Offering a flexible schedule is about the same. You can go down the list. You can see many more are planning to offer those ones at the bottom, new benefits, promotions, time off. So they're actually moving away from just increasing pay, and they're starting to do these other things a bit more. Flexible schedules still about half as they were last year. And that's a huge number, obviously. If half of the businesses in this area are really considering putting flexibility into their schedules, even for their core payrolls, that's quite something. And among those that we surveyed, when we asked them what are the most effective retention strategies, 53% actually said flexible schedules, which was up from 44% last year. So there's a greater awareness of the possibility of flexibility, and there are more businesses that are actually able and willing to provide that flexibility to attract and retain their staff. Now, the good news, as we look for more flexibility, both for economic reasons and for reasons related to the labor market, is that flexible workers are actually becoming a better option. We interviewed these survey respondents about their experience with flexible workers and temporary workers, and we found that along every axis here, the results were better in this year's survey than in last year's survey. It's easier for them to get the candidates they need, and the satisfaction overall is really rising. So there are fewer times when they say that the workers don't have enough skills or knowledge, fewer times when they say that they're not punctual or not showing up, and fewer of them need a lot of training in order to be effective. In fact, overall, about 2/3 of these businesses said that flexible workers performed as well or better in 2022 than they did in 2021. And that's good news. It means that there's an adaptation process going on, and there's also quality in the labor pool. Both of those things are helping to make this a better, more viable option. And in terms of fill, 57% of businesses, well over half, said they were able to fill more than 3/4 of their requested shifts. That's up from 36% in 2021. And that's something that we experience too. We see it on our platform. Our fill rate is above 90% for these types of jobs. So it's not surprising to see that overall businesses were having a pretty good time when it came to filling the shifts that they were requesting from whatever platform they were using. So I want to talk a little bit more about this role of flexible work in dealing with the challenges of the labor market and the economy overall. And I like to use this diagram, which shows how you can turn your payrolls into a sort of portfolio. When investors talk about how they reduce risk, they usually talk about diversification. If you can bring together a bunch of different assets that have different attributes and behave differently in the market, then you reduce your risk of a washout, you reduce your volatility. There are a lot of things that investors like about a diversified portfolio. Well, you can diversify your labor supply as well. You could have a core of permanent full-time workers, then you might have some permanent part-time workers as well, but then you might also have flexible workers, some of whom are on call and some of whom are available on a long-term assignment. And by having these extra components, it means that you can vary your payrolls according to demand. You can make sure that when somebody can't make a shift, there's another flexible worker who's going to pick it up. You can make sure that if demand drops off, then you can trim shifts a bit and not spend money that you don't need to spend on labor. So deploying these different types of workers can help you to reduce the risk of downtime, and you can be more agile when it comes to responding to demand. And actually, when we look at it, it's not surprising to see that with the greater availability of flexible workers, there's a lot more use of flexible workers in this workforce. Up to 69% of the businesses that we surveyed in last year versus 57% using them the year before in 2021. So now it's over 2/3 that are actually using them. And like I said, a lot of what's driving this is the availability of the labor, as well as the demand, the need to be able to become more agile. The network on our platform has grown to, as I said, more than 4 million workers. And a lot of that growth has just happened in the last year to 18 months. It's been very steep as more people look for ways to get flexibility into their work schedules, but also with rising prices and rising interest rates, ways to earn extra income. The great part about it is flexible workers are really available on short notice. If you work on a supply chain, you've heard the phrase just in time, right? Just in time supply chains, just in time deliveries. Well, now it's possible to get just in time labor as well. And this is sort of the holy grail of this whole business. If we look at the average time it takes to assign a worker to shifts on our platform for the ones that do fill, we can see that for all of these roles that we staff in this sector, it's under 10 hours. So you really can just decide almost at the last minute what type of workers you need, how many workers you need, what shift times you're going to offer in order to really fine tune and calibrate to demand. So just-in-time labor is something that it really helps you to be more agile, as I said. And you can also make it even easier by adding workers to a roster and then dispatching shifts exclusively to them. So you know exactly what you're getting. And in fact, we have some companies that would audition a whole bunch of our pros and then put a few of them on the roster and then dispatch shifts just to those that they had a good experience with. It's sort of a try before you buy as well. You can also, of course, have flexible workers who commit to you. You know, as I showed on that previous slide with that diagram, you can have flexible workers who are still on a long-term assignment where they come in for a month or 3 months, and they just book a huge number of shifts from front to back. You can even hire them permanently. You know, you can calibrate that relationship however you want. And it's true, not just on our platform, but others as well, where if you find a worker and you have a successful relationship, you can intensify that relationship, you know, with a long-term assignment or a permanent hire. So there's flexibility in terms of that relationship as well. I wanted to add just a few case studies here to explain a little bit more of how this all works. I think these can be pretty illustrative, and these come from our experience. So one of our business partners is a clothing manufacturer out of California. They have big warehouses and they have to do a lot of volume. Right now, they're using our platform for between 50 and 90 packer shifts per month. And it really depends on demand. You know, we flex with them. They always have that core group of at least 50, and then they're adding more as they need it. Now, with that core group of 50, they know they're not going to have downtime because they have a lot of workers who've worked on their site. They know that if one worker doesn't pick up their usual shift, somebody else is going to pick it up. And they know that they can bring in the extra help when they need it. Another example is an organic food distribution company that has a warehouse here in New Jersey, in the New York area. They went, I kind of hinted at this before, they tried out about 100 of our pros on single shift basis before putting 20 of them on a roster. They now use those 20 as 100% of their hourly workforce. We actually asked them if they wanted to hire these folks permanently, since these were the folks doing all of their hourly work. And they said no, that they liked the flexibility on both sides. The workers appreciated that they didn't have to ask for time off, and the managers liked the fact that they had no downtime and that our platform was handling all the recruitment and for them and the transactions and the accounting. So it works for them just like that. A third example is an e-commerce receiving and fulfillment operation in Texas. It's a huge operation. They do 700 shifts per month with us on average, and that includes some long-term assignments and some that have been hired permanently. So they have this whole spectrum of relationships with our pros, from just working one shift at a time, when they bring in a huge volume of people, to the ones that they've singled out for long-term assignments and actually for permanent hires. So hopefully this gives you some idea of how things are looking in the sector right now. There's much more information in the report, which is on our website. It's easy to find if you just go to instawork.com and look at our resources. Our economic research page has a link, or you can just search for state of warehouse labor and it'll pop up in Google. But the idea here is that there are still some challenges for this sector. This is a year where we're facing a lot of economic uncertainty, and being able to react to those changes in demand, whether it's a downturn or a recovery that comes maybe sooner than some people expect, those things are going to help your business. And I think diversification is the way to get that. So with that, I'd be happy to take your questions and look forward to hearing what you folks have to say.